Good afternoon, everyone. Time for another silver update. The reason why the updates recently have been coming so fast and furious is just because of the volatility of the markets recently and the swirling controversies going on. I've had so many people ask me to comment on so many things. I want to jump in and comment on a few things. But I wanted to start out with a really important chart that a lot of us follow. This is a gold and silver cross. You can do this yourself. It's on netdania.com. And I'm going to go ahead and just show you how to do it because a lot of people don't know how to do it. So the first thing you want to do, we're going to make silver our primary price. So we'll just select silver there. We don't have any indicators running or anything like that. Then if you go and choose gold, you're just going to switch to gold. So we don't want to do that. What we want to do is select silver, and then we go down to more instruments. And if we choose gold, US dollar spot, double click it, then we get the option to overlay, and that's what we want to do. So here we're overlaying the price of silver to gold. So silver is in the black lines, it's in the candlesticks, and gold price is in the regular line chart. So and it's in light blue. That's how you distinguish them. So first of all, there's a lot of things to observe about this chart, but first of all I want to observe that here's the silver smackdown here. If you notice, right before we had the silver smackdown, we actually had a big run up in gold. The gold price is over here on the left, the silver price is over here on the right. So silver had run ahead of gold quite a bit. You can see the difference, and you can always check the equivalent price. So for example, at this price here at the peak, when silver was at 49.60, that was the equivalent of 1571 gold. So these are all dynamic based on the minutes of the chart, but they're always informative for educational purposes. So the first thing I want to point out is that this change here, the drop that occurred in silver and then gold followed, actually if you look closely you can see gold spiked and silver was coming back, and this is a series of margin hikes at the CME that eventually brought it down, and silver began to lead gold down. Now you can see that they've flip-flopped, and I'm going to talk quite extensively about these margin hikes because they're becoming controversial, and I'll try to make my position clear on them. You can see that they kind of flip-flopped at this point. Silver was leading gold up, they crossed, and now silver is leading gold down. Now gold has crossed up and seems to be leading silver back up. So just to get a look at that dynamic, I want to pull out to a longer view. If we go out to our daily view, we can see we get a good view of the bottom in 2008. Now this chart's not going to show you, but silver actually, it's more dramatic than this. As percentage wise, silver corrected much more than gold. We'll see that when we go out to the weekly. But the first point I wanted to make in regards to this comparison here is that you can see from the bottom of the financial crisis, which was roughly in March for the financial the stocks and bonds, etc., in the economy, but the metals bottom was in the fall. From those points, gold kind of did a steady rise here. We'll use some lines so you can see. Gold did kind of a nice steady rise. Do you see that? Well, silver did more of a flat line and then catch up. Do you see that? So percentage wise, the two have pretty much moved in together in unison, but or tandem, if you want to use that term. But this crash in silver, of course, now has brought silver way back, something similar to the divergence that was here. Now, one of the arguments that a lot of people make is that silver is so much more volatile. So let's examine that. Let's go all the way back to let's start with our monthly charts. So let's get all the way out. First of all, we want to establish our bottoms in these two so we can make some comparisons. basically the bottom for gold, the raw bottom, we're just going to call it 250. And it touched near there a number of times. It didn't quite get that low, but just for round numbers sake, we'll use that. And the bottom we'll use for silver is $4. So here's our rise in gold that I pointed out. More of a steady rise. And silver was doing the same thing until the Bear Stearns debacle right there, which ultimately brought down the entire financial system. It did bring down gold, but then gold turned around. Silver took longer to turn around and then went on the ascent to catch up with gold. So if you're talking about this time frame, yes, silver is more volatile. If you're talking about the time frame from here to here, they have the same volatility. So you have to be very careful about what you're talking about. Now, one of the reasons, of course, that silver is quote unquote more volatile is because how tiny the market is. And that's another issue that I need to address in another video. I'll probably actually do an office series on it, but I wanted to touch on it briefly. Silver should not be any more volatile than gold. And the dollar amount of silver outstanding should be roughly equal to the dollar amount of gold outstanding. Silver and gold should be roughly be equal. So if you took all the gold above ground, which is, what do they say, 10 billion? I don't know. The figures I've used before, 15 trillion. All the silver above ground, 1 billion, 50 billion. So they're way out of whack by an astronomical amount. Now that has to do with the demonetization of silver, while gold is still money used by the central banks. So that's a whole nother topic. I'm going to get into that at some point in time. But that's partially the explanation of why the volatility of silver is what it is. But it doesn't explain this difference. Now, to examine this difference a little bit closer, I want to look at margin rates. And this is what has been so controversial right now. So for you, just to give you the ability to do some clear thinking about margin rates, I want to just examine them and compare gold and silver so you can see just the raw numbers and what we're talking about. So first of all, let's look at the primary contracts. Our primary contract in gold is this CBOT. There's also a gold COMEX. These are the same. They're roughly equal. You can see this column is initial margin, maintenance margin. We're not going to pay attention to maintenance margin. We're just going to look at initial margin. So we want to do the math real quick, and we know that to control 100 ounces of gold, you have to put up $6,500 in initial margin. So we want to pull out our calculator and do the math on it real quick. We know that the contract is 100 ounces of gold, and we know, let's just say for round number's sake, that the price is $1,500. So to control the contract of gold, you're putting up $6,500 to control the $150,000 worth of gold at current prices. So let's do that math real quick, and we'll take our $6,500 and divide that by the total value of the gold that we're controlling. I do one too many? I think I did, so we'll go back. Oh no, that's right. So that equals 4.3%. So to control 100 ounces of gold on the CBOT or in the COMEX, you need to put up 4.3% of the value of that gold. Now, let's go down to silver. These margin hikes that we see here on silver are not the bottom. Actually, there's a lot of houses calling for $30,000. So, but we'll use this number. Now, with silver, you control 5,000 ounces of silver. So, let's look at the price of silver. We got 5,000 times 35. So you're controlling about $175,000 worth of silver. Now, at the top, when we were 50, it was $250,000. So that's, a lot of people have talked about, well, hopefully with silver falling in price, we're going to see the CME or the various houses reduce the margin requirements. I wouldn't bet on it. And I'm going to comment on a Stella Concepts video that's out about this issue, and ultimately, is it a good thing? Is it a bad thing? I think ultimately probably it's going to be a good thing. We want them to be 100%, but we're not just talking about, is it a good thing that futures markets go out of existence? I don't think so. I think we'd rather have honest futures markets than no futures markets, but that's just my opinion. We'll look at those issues when we look at Stella Concepts, but let's look at the key point here. The key point is this, that when we take the value of this silver contract, which is 175,000, so we're going to take what our margin requirement is, 21,600. We're going to divide that by the value, you can see we've got 12.3%. So just on rough numbers, these exchanges are requiring 4.3% to carry gold, 150,000 worth, and they're requiring, where's our silver? They're requiring 12.3% to carry 175,000 worth of silver. So we're talking a threefold difference. The maintenance margin on silver as a percentage of the value of the contract is 3 times that of gold. Now, let's go back to our chart. Why? Is there volatility in silver that justifies this? If we clear our lines, and actually I'm going to just have to go back and completely reset. So we'll just reset this. Anytime you need to do that, you can just reset it when you're on NetDania, and then you can just maximize your chart, pull it up again, pull up the silver, overlay the gold, and start over. That's if you have too many lines. It's a lot easier than clearing out all those lines. You can just start over, sort of thing. So it's always informative to just take these out. You can't overlay the ticks. I'm not sure why that is. The closest you can overlay is 1 minute. So as we go out, we can see these two markets track each other. They're pretty tight, but they do have divergences where they break apart. This was a big one right here. But generally they track each other. So the question we have to ask is, if these track each other so tightly for most of their movements, now you can see here's a big divergence. Why should the margin requirements of one be 3 times as a percentage the margins of the other? We're saying, well, it's because it's volatile. Well, no, it wasn't. Silver wasn't any more volatile than gold for a tight time frame back here until they raised the margin requirement. It was the margin requirement raise that created the volatility. Do you see that? So that's a disingenuous argument to say that silver should have been raised. You can see our price of gold on our equivalent is $43. Without these margin requirement changes, assuming, which we didn't have with gold, the price of silver right now would be $43. It wouldn't be $35. It would be $43. So argument is disingenuous. There's something else going on behind the scenes. Now I want to jump over to a raw dog video, and I've been asked to address that. It seems that raw dog, I don't have anything against him personally. I'm not really sure if he's a silver bug or not. Not really sure he's sure, but he does a video called Silver Lies here, and he talks a lot about him being afraid that there's a lot more silver out there than we think there is. He talks a little bit about the silver eagles that are out there, so let's look at those silver eagles. You can pull this up yourself. Just go to Wikipedia and you can find the Silver Eagle article, all the stats about it. You also have your stats down here about the total. Kind of interesting here that we don't have 2010 totals yet. You'd think that wouldn't be that hard for them to figure out, but I think the number is really big. So let's just throw that on there and say, you know, with this year and last year, let's say we did 300 million, because we know it's growing, possibly exponentially. So this is the number of silver eagles in existence. Melted down? I doubt it. I doubt if any silver eagles have ever been melted down. I don't think silver has ever reached the price like it did in 79 on an inflation adjusted basis where there would be a reason to melt coins so that they could go back to industrial use. There's no reason at these low prices. As Jason Hommel said, the price of silver needs to be $500 given the money supply. You might see some melting of eagles at $500. You're not going to see melting of eagles below 50. So we can assume that all these eagles are out there. We're going to call it 300 million ounces. And we've got 300 million ounces times $35 is what they say it's worth. We know they're going for more on eBay, but so that comes to $10 billion, $10.5 billion. So all the eagles they've ever made are $10.5 billion. Now, I personally collect Perth, so I know a lot of the numbers on Perth. The tigers that I have were at 300,000. A lot of the koalas I have are at 300,000. The 2007 koalas are at 100,000. So it's a fraction of these numbers here, but we'll give it to them. We'll say that if we toss in the Philharmonics and the Maples and all the rest, I don't think it's anywhere near this number, but let's just say it's a billion out there. So let's say we have 1 billion ounces of numismatic or coin-based silver out there. So that's $35 billion. We don't even need a calculator for that. So what does that tell you? Well, there's roughly $15 trillion of gold out there, and there's 35 billion in these. So let's do the gold eagle just for comparison's sake and see how much we have out there of the gold eagle. Hopefully we'll get mint statistics on those as well. And I guess we need to put wiki. So here's our gold eagle. No, wrong one. American gold eagle. And we don't get the stats. That's kind of interesting in and of itself. So if anybody does know what the mintage numbers are for the gold eagle, so we can do a comparison to see how many are out there, what they're worth, I'd be interested in that. So let's jump over to Stella's video, and Stella does a video on, 2 videos actually, on the raising of margin requirement. And I disagree with him on some points. I think he's got some great points here, but I don't, I'm not a Stella basher. There's a lot of people that bash. I think he's an above board guy. I think he tells you what he says what he thinks. He thinks what he says, and he says what he thinks. I think he's an honest guy. So nothing against Stella. I just disagree with him on a couple of points. One of the points he makes in his video here is he talks about the housing bubble. He talks about how all kinds of borrowed money came into the housing bubble, speculators came in, and it created this gigantic bubble which crashed, and he's comparing silver to it, and he is saying that's a good thing, which I agree it's a good thing to stop bubbles from forming, but I don't think even a mini bubble was what we saw in silver. I think silver was trying to get back to some kind of reasonable value, but it moved fast and it scared the powers that be, and they pulled out all the stops to smack it. That's just my opinion. But anyway, so let's examine this idea of the housing bubble. Now, if the housing bubble were a comparable bubble, then you would have housing futures, right? You would have futures on housing where people could speculate the value of housing is going to go way, way, way up. Somehow they could take delivery on that housing. I don't know how you would make that so. It would be difficult, but you'd have all this money flowing into paper instruments that supposedly invest in real estate. I guess real estate investment trusts or something like that. And all of this borrowed money could flow into there, and the thing would blow sky high and then crash. Now, the outstanding value of real estate in this country and in the world is in the trillions, tens and twenties, even hundreds trillions of dollars. So how much is the money out there compared to that? I don't know. but it's probably a fraction, or roughly 1 to 1. But nothing like this. This is the volume I've been following recently on the SLV. This is the SLV trading roughly an average of 200 million shares a day. And if we look at just since April 25th or so, there's over a billion, 1.5 billion ounces of silver going back and forth. Now, we know that about 750 million to a billion is mined every year. So here's an entire year's worth of silver, and that's not looking at the volumes here on the CME, because these volumes are phenomenal. 150,000 contracts daily, and it's more than that, so it's 200,000 or 300,000. So let's just say 200,000 contracts trading daily. That's 200,000 times, let's say it's 5,000 per contract. So that's a billion ounces of silver trading every day. A billion, a billion, a billion, a billion, a billion. So that's the bubble. The bubble's in the paper. The bubble is in fake silver. And physical silver is nowhere near that. You have a billion ounces trading a day, and with your Silver Eagle, you have a third of a billion being all that's ever been minted in the history of the coin. So we're looking at two markets. I agree a little bit with some of the people who are talking about the margin hikes being needed, but that's not what was behind these margin hikes. You can't blame it on volatility, because the hikes created the volatility, and you can't explain the difference between silver and gold margins as a percentage, except for the fact that the silver market was beginning to threaten the powers that be, and they had to do something to stop it. We'll see if they can succeed. I don't think they can. They might have bought in some time. I'm of the school that silver's going to bounce back. I expect 50 to be exceeded before the end of the summer. I don't think this is another 2008. We're going into an election year. I don't think they are willing to risk a financial collapse. I think they just took a shot at silver, and it will ultimately fail. But time will tell, and we'll talk to you next time.